Hello, in this video we are going to see the lending cycle in the USA and the significance of Freddie Mac and Fannie Mae in the lending cycle. So let's get started. We will start with some of the key terms. Let's start with mortgage, a very basic term. Basically, a loan taken for buying a real estate is called a mortgage loan. The property of mortgage loan is that it is a secured loan. So when a loan is secured, it means that the bank or the lender can recover the loan if in case there is a default. So there is a legal mechanism put in place which allows the lender to take possession and sell the secured property. This process is called foreclosure or repossession. So thereby it guarantees that the bank would not be losing money significantly on a mortgage. Fungible. Fungibility is a financial term. It implies that the two things are identical in its specification. Let's see with an example. So if you have a $1 bill and somebody has another $1 bill, they would be having the same value. So you can exchange one for another. So this $1 bill is fungible because they have the same value. Now you say that you have a Toyota Camry, another friend of yours also has a Toyota Camry. They would not be having the same value because there would be several attributes that would be differing once you have purchased the car, used it. Different attributes would imply that the value of these two assets are not equal, thereby meaning that they are not fungible assets. So fungible examples are stocks, bonds, common shares, options, dollar bills. They are the examples of fungible goods. Now let's see what is a security. Security is a fungible financial instrument, and it is like a stock or a bond or a debenture. They are basically the examples of security. Okay, now let's see what is a bond. Bond is a kind of security in which the issuer, the one which is issuing the bond, owes the holder, the creditor, a debt. So these bonds are sold in secondary market and purchased by investors. And what they would be given is if they have put a X amount of money, they would get a X plus delta amount of money. uh, Mortgage-based security. We'll see this mortgage-based security in much more detail later, but let's see very succinctly what it means. It is a type of bond which is secured by a mortgage or a collection of mortgages. Now coming to the main core thing which we wanted to discuss, which was the US mortgage market and the cycle which we see in the US mortgage market. So how the market operates. We have individual home purchasers, home buyers who take mortgages from a lender. So this is a lender is selling the mortgage, and lenders have to get mortgage debt off their books. Okay, so what this mean is that the lenders would be giving mortgage to multiple homeowners. So they'll be giving the mortgage to multiple homeowners. If they have to keep on giving this debt and they have a limited amount of money allocated for loans, then the way they can do utilize this limited amount of money is that by selling these mortgages to a secondary organization. So what they can do is they can get these mortgages off their books by selling these loans to large banks, and they can sell it to Fannie Mae and Freddie Mac also. Now Fannie Mae and Freddie Mac are government sponsored organization, which means that their policies and processes are dictated by government policies. uh, but they are private organizations but backed by government. So they purchase these loans if in case these loans subscribe to some of the policies which are there. So now the bank has the money because they have sold these mortgages off their books to Freddie or Fannie or to another large bank, and they can have that money to sponsor new loans. Now let's see what Fannie Mae, Freddie Mac, or large banks can do subsequently to these loans. What they can do is they can bundle these different mortgages. So they have n number of mortgages. They can bundle it together and they can sell them as a mortgage-based security. Okay, and the investors can go and purchase these securities because they would be getting some interest income on these. Let's read it. Mortgage-based security. large institution also need to get the mortgage debt off their books, so they create the MBS. So we saw here lender wanted to have this off their book, so what they did, the lender sold it to these. Okay, now because these entities, large banks, Fannie Mae, Freddie Mac, they want to get it off their books, so what they do is they make MBS out of it and sell it to the market. So that's what is happening here, it is being sold to the market. Okay, so now let's see, let's read this. Investors have become less willing to invest in mortgage debt via large banks. So since the 2008 crisis, the reputation factor of these large banks has gone, and thereby investors are not likely to purchase it from the large banks, but they still have trust on Fannie Mae and Freddie Mac because they are government backed organizations. So that's what is mentioned here, but they still want to invest through Fannie and Freddie due in part to their implicit government backing. So this is the flow. So let's succinctly see. Mortgages are there. Mortgages are given by the lenders. Lenders sell these mortgages to large bank, Fannie Mae, Freddie Mac. These want to get it off their books, and then they to get it off their books, what they do is they package it into a security and sell it in the investor market. Now, to have the detail again articulated little more nicely, the same thing being articulated one more time. So mortgages are there, lot of mortgages, and these mortgages go into something called as a mortgage pool, and then there are different risk categories. So some lenders have a good FICO score, they are like 800 FICO score, let's say the best FICO score. Some have less credit worthiness. So based on the credit worthiness, different mortgages have different risk factors, and based on the risk factors they guarantee different kind of interest to the investors, and the higher the interest rate, the more there is a risk. So the same thing represented one more time. We have multiple buyers which are there. We get a pool of mortgage loans. They are categorized into the categories of AAA, triple B, unrated, all those things. And the first one to make a loss here, if in case these people default, this guy, this guy, this guy, let's say they are not able to pay their loans, then these are the people who are at the highest risk level and they would be losing their money in the first place. And these are lowest risk people. As we go, as the bond rating increases, we go up and the rate of loss would be less, but at the same time the expected yield will also be, the expected percentage yield will also be less because we are taking less risk here. Now there is a difference chart between Freddie Mac and Fannie Mae, which is represented here. For the foundation year, Freddie was 1970, and this is way old. It is 1938. And then there is a D abbreviation for this: Federal Home Loan Mortgage Corporation, Federal National Mortgage Association. This is helping the small banks and lenders. This is helping, Fannie is helping the big commercial banks. Purpose of creation: this is meant for giving loans, a loan market available, the mortgage market available, thereby helping facilitate the mortgage so more and more people are able to purchase houses. That is the main intention of this formation. And Freddie Mac was formed so that there is a competitive environment. If there is only one organization, competition is not there, thereby the interest rates can go high beyond imagination. So thereby there was a competition which was created with the help of Freddie Mac. Freddie Mac offers home possible loan. I have put a link down what is the meaning of home possible loan and what is a home ready loan. You can go and see what exactly this means and how it affects your down payment requirements with respect to your credit score. Usefulness: it helped in keeping the interest charges at the minimal rate and expanding the secondary mortgage market. It helped in reigniting the mortgage lending system. Basically, they are both meaning the same thing. Okay, with this, I'll end this video. Thank you very much.